Did you know that Warren Buffett, one of the wealthiest people in the world, built his fortune by following a simple yet powerful investing strategy? It's not about taking big risks or chasing trends. Instead, Buffett focused on investing in businesses with long-term potential, and this approach has made him one of the most respected investors of all time. The best part? You don't need to be a financial genius or have insider knowledge to apply Buffett's strategy. Anyone can use his principles to make smarter financial decisions. Whether you're new to investing or have been doing it for a while, Buffett's wisdom can guide you toward success. In this video, we'll break down Warren Buffett's key investment principles and show you how you can apply them. Stick around until the end, as we'll reveal one crucial investing rule that Buffett follows religiously. A rule that's helped shape his massive success. You won't want to miss it. Before we jump in, make sure to hit that subscribe button so you don't miss our future videos on investing, personal finance, and more. If you like what you see, give us a thumbs up and share it with your friends. Let's dive into Warren Buffett's secrets. Warren Buffett's key principles. Buffett's investment strategy isn't about luck. It's about following a set of clear principles that anyone can understand and apply. 1. Invest for the long term. One of Buffett's most famous quotes is, "Our favorite holding period is forever." This reflects his belief in long-term investing. Instead of chasing quick wins or reacting to market fluctuations, Buffett invests in businesses with strong fundamentals that will thrive over the years. By staying focused on long-term growth, Buffett avoids getting caught up in short-term market movements. This patience has been one of the keys to his success. Investing for the long term allows him to benefit from compound growth and avoid the stress of daily market swings. 2. Understand what you invest in. Buffett only invests in companies he truly understands. He has often said, "Never invest in a business you cannot understand." This principle helps protect investors from making risky decisions. Buffett has built his fortune by sticking to simple, easy-to-understand businesses like Coca-Cola, Apple, and Geico. He invests in companies with clear business models that he can evaluate. This means he doesn't waste time or money on businesses that are too complex or unpredictable. If you're starting out in investing, stick to industries and companies you understand. When you know how a company works and what factors influence its growth, you can make smarter, more confident decisions. 3. Look for a competitive advantage. Another key principle for Buffett is investing in businesses with a moat, a competitive advantage that protects them from competitors. A strong brand, unique products, or a large market share are all examples of moats that help businesses stay ahead of the competition. For instance, Coca-Cola's brand loyalty allows it to maintain strong profits even in tough times. Buffett looks for companies that have these types of competitive advantages because they're more likely to succeed over the long term, even when the market is tough. When considering an investment, ask yourself, does this company have something special that keeps it ahead of its competitors? If the answer is yes, it's more likely to be a solid investment. 4. Patience is key. One of Buffett's greatest strengths is his patience. He doesn't rush into investments based on hype or emotion. Instead, he waits for the right opportunities, invests in solid companies, and holds on to them for the long run. Buffett often says, "The stock market is a device for transferring money from the impatient to the patient." This highlights the importance of staying calm during market volatility. If you make smart investments and hold them long enough, the value will eventually rise. Patience is one of the most important qualities an investor can have. Don't panic when the market dips or when short-term trends aren't in your favor. If you believe in the company's long-term potential, stick with it. Buffett's rule of thumb: the importance of value investing. Buffett is known for his value investing approach. This means he looks for businesses that are undervalued by the market, companies that are trading for less than their true worth. One of the best examples of Buffett's value investing is his purchase of American Express in the 1960s. At the time, the company was going through a tough period, and its stock price dropped. However, Buffett saw the value in the company's brand and long-term growth potential. He bought the stock at a discounted price, and you need to focus on the intrinsic value of a business. Don't get caught up in the hype of short-term market trends. Instead, look for businesses that are undervalued based on their potential to grow and succeed in the future. 5. Protect your capital. Never lose money. Warren Buffett's most important rule is also one of the simplest, and possibly the most powerful. Never lose money. At first glance, this might seem obvious, but if you really dig into it, this rule is the foundation of Buffett's entire investment philosophy. It's not just about avoiding bad investments. It's about understanding the risks involved and taking steps to protect your capital from unnecessary loss. In the world of investing, risk is inevitable. Markets go up and down, and every investment carries some level of uncertainty. However, Buffett's approach is about managing that risk in a way that minimizes the chance of catastrophic loss. He understands that losing money can be a huge setback. Even if you make gains later on, losing money can take years to recover from, both financially and psychologically. That's why Buffett stresses the importance of focusing on investments that are stable, reliable, and have lower chances of losing value drastically. Buffett doesn't invest in speculative stocks or high-risk ventures that could result in substantial losses. Instead, he prioritizes businesses with strong fundamentals, proven track records, and a clear path for future growth. Companies with a steady history of success, strong cash flows, and reliable business models are the ones he targets. This minimizes the risk of losing money, which is crucial for long-term wealth accumulation. As Buffett often says, the most important quality for an investor is temperament, not intellect. If you're too focused on high returns without considering the potential for loss, you might make impulsive decisions that hurt your financial health. Another key element of protecting your capital is avoiding the fear of missing out, FOMO, on hot trends. The world of investing is full of new, flashy opportunities that promise huge returns in a short time. But more often than not, these investments are highly speculative and come with significant risks. Buffett stays away from these types of investments because they don't align with his core belief of protecting capital. It's easy to get excited by the latest trend, but the best investors know that patience and discipline, rather than chasing the next big thing, are what lead to lasting success. Before making an investment, always ask yourself, what's the risk? If the potential loss is too great, it might be better to pass on the investment. Keeping your money safe is just as important as growing it. Warren Buffett's investing philosophy may be simple, but it's incredibly effective. By focusing on long-term growth, investing in businesses you understand, looking for companies with a competitive advantage, and staying patient, you can build a strong, profitable portfolio. Buffett's strategy isn't about taking shortcuts or chasing after the latest hot stock. It's about making informed, disciplined decisions that lead to long-term success. Whether you're just starting out or have been investing for years, these principles can help guide you on your financial journey. If you found this video helpful, don't forget to hit the subscribe button so you can stay updated with our latest videos. Give us a thumbs up if you enjoyed the content, and share it with anyone you think could benefit from this investing wisdom. Thanks for watching, and good luck on your investing journey.